let's say a stock is trading at 100 rupees. So அதை வந்து ஒரு group of people வந்து பார்க்குறாங்க. They analyze the company and they see that the business is good and they purchase the stock. ஸோ கொஞ்ச நாள் அந்த ஸ்டாக் வந்து இட் ரீச்சஸ் 200 rupees. ஸோ அதுக்கப்புறம் கொஞ்சம் பேர் வந்து பர்ச்சேஸ் பண்ணுறாங்க. ஸோ ஆஃப்டர் தட் த ஸ்டாக் ரீச்சஸ் 400 rupees. The only difference is the people who bought at 100 rupees, they looked at the business of the company, the balance sheet, annual reports, then they valued the company. After that, they purchased the stock, seeing that it is undervalued. But the second group of people who purchased the stock, they didn't actually see what the business company is all about. So they simply looked at the momentum of the stock. Through some technical analysis, they just bought the stock. After the stock reached 400 rupees, the second group of people actually they bought some more stock. And in the first group of people, they purchased the stock, they kept the company on the radar and they looked into the balance sheet, tracked the results of the company on a quarterly basis. Found that the company had actually recently acquired a lot of debt, so they sold their stock when it actually reached 400 rupees. Day of the slaughter came, so when the stock was trading at 800 rupees, the company defaulted on its debt and the stock price came tumbling down. So the second group of people who actually purchased the stock based on the momentum and the technical aspects of the stock picker, they lost actually all the money they invested. So the moral of the story is you should look at the business for buying a stock. Basically, business is what drives the price of the stock. If the business is not good, then the stock will will not be faring good. Let's see this company, which is Diwan Housing Finance Limited. Basically, this was the business was good in the beginning and a lot of people actually bought the stock. There were some people who also bought the stock based on momentum and other things, but there were some people actually who were looking into the business of the company and then they bought. So these people actually they noticed at one point in time that this company was borrowing short-term money and lending for the long term. This was actually leading to asset liability mismatch. So due to which they actually saw the danger that the company is going to actually default. So they actually bailed out. They sold the stock and they came out. But the people who actually bought the stock just by seeing the momentum and the technical aspects of the stock ticker, they held on to the stock. They even bought more. When the company defaulted, the stock price actually came down. So when the stock price actually increases, it will actually increase gradually. But when it comes down, it will actually comes down very fast. People who invested based on the momentum and other things, they actually lost money in the transaction. This is one thing. And the other thing is sometimes actually stock is bought based on the management. Let's say Adani group of companies. So there is one group, one company which is doing good in that group. Based on that, the other Adani group companies are bought blindly. Or let's say Tata Group. So it's a very good management. But if they actually invest in an airlines business, it's not actually a good business. Really, if a management with a good reputation takes over a business with a bad reputation, it's the reputation of the business which is intact. The business of the company should be such that any stupid can actually run the company. Let's say Coca-Cola. This company it's a very simple business and anybody can actually run the company. So what it means is of the company is very important. So if the business is not good, then even if the management is good, then the business will not perform. So this will actually impact the stock price. So business is what actually drives the stock price, not the other way around. So in a nutshell, stock does unto you what the business does unto the stock. So purchase the stock for company which has a good business and when the stock is actually trading at a price or at an attractive price.